Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about inflation or the more recent CPI report. We will also discuss the effects of that on risk assets such as crypto. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Link is in the description below. Let's go ahead and jump in. So we did just get the most recent CPI report, and you can see that headline inflation is still hovering just above 3%. And this is something that we speculated was going to be an issue for the Fed because it is much easier to go from, say, 9 to 8 or 8 to 7 than it is to go from 3 to 2. In fact, it was in the 1970s when we saw inflation drop down to about 3%. And the Fed pivoted too quickly, and then we saw a second wave of inflation. And in fact, it was during that second wave of inflation where once it started to get going, you can see that the S&P 500 hit another market top, which ended up being a slightly higher high compared to the top from November of 1968. And so the Fed has to essentially thread the needle between how do you bring inflation back down to 2% without leading to a slowdown in the economy. If they pivot too soon, then rather than get a slowdown in the economy, it could lead to the reacceleration of inflation, just like we got in the 1970s. However, if they were to stay too high for too long, you could get a period of deflation where you see the inflation rate. I mean, you can see here we went into deflation back in the 1940s, also coming out of a period of high inflation after World War II, and we went into negative 3%. So when people talk about, will the Fed achieve a soft landing, you can see how difficult it is. It's not impossible, but it's difficult because the Fed has to essentially pivot soon enough to avoid a deflationary crash like the 1940s, but they need to wait long enough so that we don't get another wave of inflation like we saw in the 1970s. So again, that's why when we talk about the idea of a soft landing or a hard landing, this is why this is what makes it difficult is the Fed really has to know the appropriate time to pivot. And that the reason why that's hard is because monetary policy operates with long and variable lags. So for instance, right now, inflation is hovering at around 3%. Now, it's possible that if the Fed just holds at 5.5% for another few months, it's possible that inflation will just start to come back down. It's also possible that even if the Fed were to start cutting tomorrow, that inflation would still come back down because even if they were to cut 25 basis points or 50 basis points, if it's still sufficiently above the neutral rate, R star, then it might not be enough to lead to the reacceleration of inflation. So again, it's very difficult to know where that threshold is, and that's sort of the dynamic that we continue to sort of have to watch. So again, headline inflation is still right around 3%, and staying the course long enough in order to see it go back to 2% is the most difficult task. And I mean, Powell has said that it's not that they have to see inflation at 2%, but they need to see a durable path to getting to 2%. And I know they don't focus on headline inflation, but if you just simply were to look at headline inflation, there's no clear and obvious evidence just yet that it's on a durable path to 2%. Right? I mean, it's still at around 3%. And again, we can see a period over here in the 70s where we stayed at 3%, for the better part of, let's say from, I guess, all the way from October of 71 until February of 73, right? I mean, over a year, and it still didn't go to 2%. And you can see what ended up coming after it. So that is where we currently are. Can the Fed stay high enough for long enough? And that's what we're going to find out. So if we were to break this down, because I want to talk about sort of my views and why, as long as the Fed continues doing what they say they're going to do, why I do think it will slowly come down. If we break this down by category, okay, so let's look at inflation year over year per category. So this is headline, but take a look at some of these categories and you'll find that most of them are already below 2%. Food and beverages has now reached 2.25%. And you can see over long periods of time, I mean, where it is now is essentially where it is in fairly good times. It's just that the Fed still hasn't reversed course yet. And so until they do, this metric may continue to drop. If you were to look at a monthly change, you know, I was looking at this, it sort of looked like it might be leveling out here a little bit. But then this drop is a little bit more substantial than the previous one. And if you were to look at a monthly change, right, you can see that the pace at which it was dropping was going down, right? It was sort of leveling out. But this last month, it dropped a good bit. I mean, especially compared to the month before, almost twice as much as it did from the month before. So that is how you go into a period of deflation if the Fed doesn't pivot soon enough and these things just sort of slowly continue to drop. That could be an issue, right? Now, that could be just sort of a one-off thing. I don't want to imply that this single data point means much of anything. Taking a 3-month moving average would show that it's still slowing down. So I don't want to read too much into a single data point. But I mean, you can see how this metric could theoretically become deflationary. And in fact, it has gone deflationary in 2009 and even in 2016. We had a recession scare back then. We avoided it, but you can see that it did go deflationary in both of those prior examples. Now, some of these metrics have already gone deflationary, and we'll get to some of those. But housing makes up a large component of headline CPI, and it's a lagging indicator, and it is continuing to drop, right? It dropped from 4.66 to 4.55%. But because it's a lagging indicator, it takes a lot longer for that data to really show up, to be reflective of what's really going on in the economy, and therefore it might make the Fed stay higher for longer than they really need to stay high on rates, just because even if they were to pivot, there's a decent chance that housing would continue to drop just because of the long lags associated with it. But this one is still well above the 2% target. Now, when it drops, I mean, it can drop pretty quickly. So that is something to keep an eye on. But at this point, the pace at which it's dropping hasn't even really been accelerating. Now, apparel is one that is essentially deflationary now, right? Remember when we talked about food and beverage, we talked about, well, if it continues this path, it's not going to take long for it to go deflationary. You can see that apparel already is, right? Now, apparel is one of those things that can often be deflationary, so I don't really think we should read too much into it. But you can see how we went all the way up here from around 6 to 7%, and now it has gone deflationary. Transportation went deflationary back in 2023, but ever since then, it's been slightly positive. Currently, it's back to around 2.75%. So this is actually going in the wrong direction for the Fed. But transportation is one of those things that it does tend to be a bit more of a volatile series. So I don't really think it's as important to follow. Medical care went deflationary as well. And then recently it's been starting to go back up. Some of this could be due to the base effects, but February 2024 medical care inflation is now at 1.41%. Recreation. This is one that actually saw a fairly sizable drop in this most recent print, because we were at 2.77 and then we dropped to 2.09. So that's a welcome change for this series to see it actually drop down to 2%. That's just another one of the metrics that has now dropped to 2%, right? So if they all drop to 2%, that'd be nice. But again, only some of them have. Education and communication had gone deflationary, but now it's back up to 0.389%. And then other goods and services. This is one we've been following for a while as sort of one of the problem cases for inflation, because it has been hovering, 5 to 6% for so long. We just had a pretty big drop from 5.7 down to 4.74 in 1 month. Looking at a monthly change, That's the largest drop we've had in this category, right, since this whole thing began. So the Fed is making progress, right? They are making progress. But again, when this one drops, as history shows, it can drop really quickly when it does actually start dropping. So another one to keep an eye on. Now, it's important to remember that all of these different categories are not weighted the same when it comes to calculating what headline CPI even is. In fact, if you were to look at the inflation year-over-year contributions to it, and we were to isolate each and every one of them and put it up next to headline inflation, what you'll see is that food and beverage makes up a really small component. It's only 0.3 of the 3.17, right? You can see the tiny component it has of the overall headline inflation. The one that has the most impact by far is housing. You can see that, I mean, it essentially accounts for 2/3 of it at this point. And so that's why I go back to this idea of, you know, a lot of the headline inflation, the reality of it being at 3% is mainly because housing inflation has not yet come down. But I'm still putting forth the idea that it is a lagging indicator. Housing is a lagging indicator, and that it should continue to drop over the next 6 to 12 months. So that's why I do think it's more likely that inflation will go down than durably back up. And what we're seeing is just sort of the last mile of 3%, 3%, 3%, all these prints, basically forcing the Fed to keep on staying at 5.5% for their Fed funds rate. Do they pivot soon enough? Apparel, basically is taking away from headline inflation at this point. Transportation makes up a relatively small amount, but somewhat noticeable, 0.461%. Medical care, relatively small amount, almost negligible in there. Recreation, the component, relatively negligible amount, 0.1 of the 3. Education and communication, pretty negligible in the calculation there. And then other goods and services is pretty low, right? 0.12 of the 3.17. So again, housing and transportation, those are the two categories that, when you add them up, count for about 2.5 of the 3.17 that we're looking at here, right? Those two categories. So, and we just showed how transportation already went deflationary. It's starting to go back up, but we could easily see that one sort of reverse course again. If you were to go back and look at it per category and isolate transportation, and we sort of zoom in over here, you can see that it actually went deflationary in March. And we just got the data point for February. So what if, as we get into sort of the March to June, July timeframe, it's possible that it just goes deflationary again. And if housing then comes down, then you have this sort of dilemma of like, well, now it's not a dilemma, right? It's what the Fed wants. Then you have everything going down, and have they waited too long to pivot? That's sort of the question that I think we should ask. And I think a lot of people sort of look at this stuff and think that it doesn't really matter. But I would push back on all that, because I do think the economy matters. I do think the business cycle matters. I just think it takes place over many, many years, and it's easy to sort of not care about it. But that's at least, what people are mostly concerned about in the macroverse right now is what's going on with inflation, and is the Fed going to stay too high for too long? And if you were to look at core inflation, it has continued to drop, but the problem is that it's not really dropping quickly enough, right? 4%, 3.9, 3.87, 3.76. It's on the right path, don't get me wrong, but it's not dropping that quickly, not compared to what it was dropping back in the summer of 2023. So, if you could look where we just got the data point for February, this is where we were last February. So we can see that what happened last time is core CPI, again, it kind of stalled out a little bit up until the next reading. And then following that, as we went into the summer, we really started to see it fall again. So that is something else, is to look at core inflation and recognize that it is dropping, but I don't know if it's obviously on a path to 2% just yet. And because of that, the Fed's probably not going to pivot at their March meeting. And if you were to go look at interest rates, and at least what sort of the probabilities are for the Fed funds rate, you can see that the Fed is likely not going to pivot in March, only a 1% chance of a rate cut. Even in May, they're saying only about an 8.9% chance of a rate cut. These probabilities are subject to change. And I wouldn't be surprised to see them change, right? I mean, if the unemployment rate in April comes in at 4% or something, I would expect the probability of a rate cut in May to go up a lot. But if that doesn't happen, then we might not get cuts until later in the year. And the funny part about this is that in June, the probability, while the probability is still in favor of a rate cut, only, there's almost a little over a 45% chance that they keep rates at 5.5%, even in June, right? Even in June. So all important things to consider here, because this stuff, when we do get rate cuts, we know that does tend to have effect on the markets. Last cycle for Bitcoin, we saw Bitcoin find a local top just before the Fed started to cut rates. I'm sure many of you guys remember that. In fact, if we were to overlay this on the chart, you will remember that, and this is why we talk about monetary policy, right? It was right there that the Fed cut rates in July, and Bitcoin sort of topped out just before that. And what's interesting with Bitcoin is that you can almost see the exact same pattern after the Fed cut rates, right? And if you look at a bar pattern, after the Fed pause, right? If you look at a bar pattern right here up until that peak, so if we just sort of match this up, what do you notice? This is when the Fed paused right here. This is when the Fed paused right there. In both cases where the Fed paused, Bitcoin initially sold off, and then it rallied until just before the Fed cut rates. Right here, right after the Fed paused, Bitcoin sold off, and then, has this been just sort of a rally until the Fed cuts rates? And if you overlay, right, that right there, I mean, you can see it. I mean, it's not identical, right? It's not identical, but it does go to show how similar the markets are from one cycle to another, right? The Fed pauses, the market sells off, and then the market rallies until just before rate cuts. And that's exactly what we've seen over here, right? Rally until, probably sometime before rate cuts. Now, that doesn't mean that, that doesn't necessarily mean that you rally until May. You could, but the reason it doesn't mean that is because this is not going to be predictive, right? Bitcoin doesn't find a local top because the Fed's going to cut rates. The Fed cuts rates because the consumer throws in the towel, which will be reflected in something like Bitcoin finding a local top. Does that make sense? Like, that's how I think about it. I could be wrong, but that's how I think about it. I mean, I think that Bitcoin really represents the best of the cryptoverse, and it really represents the consumer, And as long as it's going up, the consumer is still holding. But if it finds some type of local top, then it would imply that maybe the consumer has reached a breaking point where they can no longer, do this and keep Bitcoin floating higher. Then it finds a local top, sells off. And you might say, well, again, the Fed's not going to pivot because of Bitcoin. You're right, they're not. But if something like that were to happen, it might imply that the consumer, the retail consumer, is starting to show a little bit of weakness. So I don't think you can look at this to say, oh, well, Bitcoin has to rally until 1 month before this is saying the first rate cut arrives. No, this stuff can all get repriced, right? These rate cuts could get pushed further out if inflation data continues to come in at 3% and doesn't budge, right? It could get pushed further out. Or if inflation data falls off a cliff, or the unemployment rate falls off a cliff in April, then this stuff can get pulled forward, right? Rate cuts can get pulled forward. In 2019, we only had 3 rate cuts. That was the last cutting cycle, when the last cutting cycle began. And back then, the first rate cut arrived in July. So, this is something to focus on, to watch. And how does it affect crypto, right? How does it affect crypto? Well, not only does it affect Bitcoin USD, but as I've said before, the higher we go, the longer the Fed keeps rates high at 5.5%, then the longer it will take, the longer period of Bitcoin dominance going higher and higher and higher. It's the same way the Magnificent Seven, right? The Magnificent Seven have sort of lifted tech stocks for a long time, but some of those are starting to fall off, right? I mean, some of those tech stocks, it's sort of like the Fantastic Four at this point. For crypto, you could make the same kind of case that Bitcoin will hold stronger longer than the rest, and therefore dominance goes up for that entire time. And remember, last cycle, it was in fact when the Fed started to cut rates. It was just after that that dominance finally topped out. So that's how it affects crypto, in my opinion, right? If the Fed stays higher for longer, which they're probably going to do with inflation still at 3%, it means that people leave riskier stuff in favor for the stuff that's more likely to survive, higher or stricter and tighter monetary policy. And so they defer to the blue chips of the respective asset classes. So that's how I think it would affect crypto. Basically, Bitcoin continues to reclaim more and more market share until sometime after the Federal Reserve pivots to looser monetary policy. But I don't think they're going to be pivoting in March, simply because inflation data continues to show it's staying at 3%, and even the market is, normally at this point, the market is pretty accurate. Like when you're only about 5 days away from the meeting, and it's 99% odds, like normally the market is right at this point, right? If it's a month or two out, obviously that can change, but something catastrophic would have to happen between now and next week for the Fed to pivot, right? And so they're probably not going to pivot, and maybe what you see happen is the market kind of boring until after that meeting, and then we figure out what the Fed's resolve is, what they're going to do. That can sometimes happen, right? And even March for Bitcoin, right? We've seen previously where March can see some type of weak period. I mean, even last year, right? In early March, we had sort of a sell-off, and even over here, right, in 2021, right? If you look at March, there was a bit of a sell-off right there. Right here, there was a bit of a sell-off, right? So, I mean, this does tend to be a repeating pattern, but not that out of the ordinary. So we'll see what Bitcoin does as we get into, next week, where the Fed and the Federal Reserve has the FOMC, and we see, are they going to keep staying higher for longer? My guess is they do, and my guess is because of inflation staying sticky at 3%, they will likely just sort of reiterate that they're going to keep interest rates higher until they see a durable path to 2%. They might, they might provide some insight on when the first cut might be. But I've often said that it's almost the pricing out of rate cuts could eventually force them to get priced back in. And you can see that, a lot of rate cuts have already been priced out. Once upon a time, the market thought the Fed funds rate was going to be at 4% by December of 2024. Now the market thinks it'll be at 4.75% by December 2024. So that has changed by 75 basis points just over the last couple of months alone. So again, the pricing out of all these rate cuts that were supposed to come could eventually lead to them being priced back in. But, that process is still an ongoing process. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. We'll see you guys next time. Bye.